Well, hello. My name is Anthony Sicaro. I'm founder and president of Providence Financial and Insurance Services, located in the heart of the San Fernando Valley in Woodland Hills, California. And periodically, I like to put out a video about what's going on in the economic environment and how it affects your investment. So the purpose of this video is primarily designed for my clients. So if you're a client of mine, thank you for your trust. Thank you for your business. You know that I don't take it lightly. If you're not a client of mine, and feel free to watch this video. If you have any questions, feel free to contact us at providencefinancialinc.com. That's probably the best way to get in touch with us. But I want to take some time and talk about how your investments are being affected by what's going on with the coronavirus and oil and some of the other things that have been causing some major havoc in the stock market. And some videos I put out that are really just informational. And certainly this video is going to have a lot of information in it, but some videos require action on your part. And this may be one of those videos depending on your situation. So I'm going to encourage you to watch this video all the way through. And really there are three things that we're going to talk about in this video. We're going to talk about whether it's time now to maybe buy some stock. We're going to talk about the volatility of your portfolios that we have for our clients. And then we're going to talk about annuities just briefly and where do they fit in. So I'm going to try to cover everything in bullet point format. I'm not going to expand on a lot of things primarily because of time. I want to cover a lot of information and certainly don't want to talk about what you can hear about in the media. I don't need to repeat everything you're hearing all day. Now, if you're a follower of ours on YouTube, then you probably got a notification right from YouTube right away that we put out this video. But if you did not get that notification, and if we sent you a newsletter or we sent you an email that has this video link in it, well, a lot of times that video, the email goes out a day or two after I do the recording of the video. So here it is, March 11th. So if you're watching this video on March 12th or March 13th because you got an email from us, then I'm going to suggest very strongly that you go right now before you finish the video, go to our website, Providence Financial Inc., and click on the YouTube button and follow us on YouTube. That will allow you to get notified much faster than us having to record the video, upload it, put together an email, and send it to our clients. It usually takes 24 hours to do. And as fast as things are happening today, 24 hours could be a big deal. So follow me on YouTube just so you can get the information faster. So if I told you that less than a month ago, the stock market hit record highs, would you believe me? Most people say no, because it feels like it's been a lot longer than a month ago. But the fact is that it was on February 12th that the Dow Jones hit a record high. And a week after that, the S&P 500 hit a record high. So it's only been 3 weeks since the S&P 500 hit a record high. And now here we are, March 11, 2020. And as I record this video, we're down. The market's down about 18%. 10% is a correction. 20% is a recession. And the market's down almost 1,200 points as I record this video, so we might be in recession territory officially by the time our trading session is over today. But right now, we're sitting down about 18%. And that certainly has affected our clients' portfolios, and I want to spend some time talking about that a little later. But the first thing that I want to talk about is it potentially time to buy stocks? What? Anthony asking if it's time to buy stocks. You know that I've known that there's or expected that there's going to be problems ahead, and now here I am talking about buying stocks. Well, I'm not necessarily recommending that. What I am saying is that we don't know where the market is going to go from here. There's been at least 5 times over the last 5 or 6 years where the market has come down double digits or more over a fairly short period of time, only to rebound and get back to where it was over a fairly short period of time. That period of time has been a month, as short as a month, and it's been as long as 3 or 4 months. And that's what's called a V-shaped recovery. Market drops and comes back. It's a V. Market drops and comes back. And that's happened very, very quickly. Now, there are other time periods going back 20 years where the recovery hasn't been so quick. If you look at 2000, you go back 20 years ago before the tech crash of 2001. If you look at 2000 And if you had an equity portfolio in 2000 that you just hung in there, you didn't trade, you didn't buy, you didn't sell, you just hung in there. Well, it took you about 2.5 years for the market to go from 2000 to 2002 to hit the bottom, and another 4 years for the market to recover. So if you had a portfolio in 2000, then 2006, you had the same value portfolio. No growth in the market over that 6-year period. Same thing for 2007. If you had a portfolio in 2007 and you just rode out the subprime debacle of 2008, well, that debacle ended officially on March 9th of 2009. And then by 2014, it got back to the previous 2007 level. So from 2007 to 2014, no growth at all in the stock market. So is this one of those times where the market over a period of 6 months is going to drop and recover V-shape? Or is it going to be more of a U-shape where it drops, stays down for a little while, and then takes a long time to come back? And is this going to take 6 or 7 years or maybe even a decade? The answer is we don't know, right? No one knows. So it's a question that I can't answer for you. But the reality is that what I've been a proponent of, and you and I, as a client of our firm, or you and your advisor who is with our firm, have had conversations about the fact that because we don't know when the bottom is going to be, it may make sense to dollar cost average back into the market for those of you that want money in the market. Now, a high percentage of my clients don't want any money in the market at all. And if you've done well and you've got a portfolio and you can live off of 4 or 5% interest and just live off your interest and dividends and so on, then you don't need to gamble. You don't need to have any money in the market. But a lot of our clients like the challenge. They like the market. They're so ingrained in the market that being out of the market would be like being naked. It would just be uncomfortable, even though they don't need to do it. And some of our clients are younger, where I think the market's a good place. So when do we get in, and how do we get in? Well, here's what you need to think about. What you need to do, and the process that you need to think about, is you need to look at your situation. Okay? You need to look at your portfolio, and you need to decide, well, out of your portfolio, how much is the maximum you would ever want in the market. Okay? So you need to really know that number. That might be 25% of your portfolio if you're a little older and more conservative, or really, if you're really conservative, it might be nothing. If you're a little younger, it might be 50% or it might be 75%. So you kind of have to know what that number is. Then what you want to do is you want to take that number, and I would divide that number into 20% segments. So you divide it by 5, and then that may be the amount that you want to start dollar cost averaging in every time the market goes down, maybe 10%. So let me give you an example. Let's say that your number's $100,000. Okay, you've got a $500,000 portfolio, and you're a little bit older, and you want to have 20% of your money in the market. So that's $100,000, and you basically have come to the conclusion that that's the maximum. You don't want more than $100,000 in the market. Okay, well then what you do is you take that $100,000 and divide it by 5. That's $20,000 or 20%, and then we have to consider, at this point with the market down in almost official recession territory, maybe we take 20% of that number, $20,000, and we invest it in the market at this point. This way, if we have a V-shaped recovery, if the market goes back up, then you're going to be glad you put 20% in the market. If the market continues to go down, as I think is more likely, and I think is the more, the consensus, as that happens, well, then the reality is that you're going to be glad you've got 80% of your money out that you can get in over time. So maybe a good strategy is put 20% in now, and then every time the market goes down another 10%, maybe you put in another 20%. So if we're already down 20%, and you put in 20% now, then the market goes down 30%, you put in another 20. The market goes down 40%, you put in another 20. The market goes down 50%. If it gets that far, you put in another 20. Market goes down 60%, you put in another 20. Well, by the time the market's down 60%, you've gotten massive discounts along the way because you have dollar cost average. Now, some of you might be looking at this rolling your eyes saying, well, 60%, that's highly unlikely. I disagree. It's likely. It's happened multiple times in history where the market's gone down that much. And if we go back to 2008, market was down 60%. So it could happen. And I have videos on that. I've got videos on YouTube about why I think that the next drop could be 60%. By the way, I'm not saying it will be. Don't misunderstand me. I'm just saying it could be. So, but what you have to do is you have to have some kind of a strategy as to how you're going to get back in the market. And do I think that strategy is right now take 100%, put your money back in the market at this point, all of what you want in the market? No, I think that'd be wrong. But doing what I suggested, I think, is a proper way to go. I think that's a good way to get back in. So that's the first thing I wanted to talk about is, should you consider buying? I don't know that answer. We're not going to make those buying moves without you. If you want to have that discussion about whether you should have some money in the market, or if you've decided that you want to put some money in the market, you need to call us or email me and let me know so we can have a quick 10-minute discussion about it. And make sure that we decide what we want to do and how we want to do it, and then we can go ahead and execute that for you. And you can imagine we've gotten calls from our clients just curious, wondering, asking questions about their portfolios. Is everything okay? We'll talk about that next. But the bottom line is we've been busy, so I'm making myself available as much as I can, even if it's off hours, to be able to address your questions. So email me. Call my office. If I have to call you on my way home from work, if I have to call you on my way in at 7:30 in the morning, that's fine. We'll make sure that we get in touch some way or another so I can answer your questions, because these are things that have to be decided pretty quickly. So that's the first thing. Should you consider buying? The next thing that I want to talk about briefly in this video is I want to talk about your portfolios. It's not a surprise, and it's not news at this point that the market has been abnormally volatile, right? I think it was 2 days ago, the market had a 2,000-point drop. The following day, it was up 1,200 points. Right now, as we speak, it's down almost 1,200 points. So it's been extremely volatile. And 2 days ago, the stock market hit a circuit breaker. So what that is that the stock market has some circuit breakers, they call them, in effect, to where if the market goes down by 7%, that's phase one. If it goes down by 7% in a day, they stop trading for 15 minutes. Well, as far as I can remember, that hasn't happened since like 2008. So it's been 11, 12 years since that happened, but it happened 2 days ago where they had to stop trading and kind of give everyone a chance to take a breath and let's not overreact and let's not panic. And who knows, today again, that trigger breaker may be hit. So we're in a very abnormally volatile market. And, as I mentioned, stocks are just kissing a recession at this point. And your portfolios are not immune to that. There is nothing immune to that, right? When the earthquake happens, all the buildings shake. When the tide sinks, all the ships sink. And everything's interrelated. The housing market is interrelated to oil. The oil market is going to affect the stock market. A virus is going to affect everything, the stock market particularly. And income-producing portfolios are going to get affected by that. So I just want to remind you, though, that the valuation, or rather the fluctuation of your portfolio is irrelevant. It doesn't matter. As a matter of fact, it works in your favor if you're not spending your income, because of the fact that we can go back and we can reinvest the cash that's in your portfolio and the dividends and interest you're earning, we can reinvest. And because your portfolios have come down a little bit, we actually get things on sale. That's phenomenal. That's a phenomenal strategy to where you can reinvest and get things on sale. So when things do come back, you're actually going to profit from that. And there's really two categories of clients out there. Those of you that are getting income from your portfolios and living off of it, and those of you that are getting income from your portfolios and not living off of it. You're reinvesting it. We just talked about that. But what if you're living off the interest and dividends of your portfolio? Well, here's the good news. The value of the stock market, or rather I should say, the value of your portfolios is irrelevant, because your income's going to keep coming in. Your income's going to keep coming in. The interest and dividends are going to keep coming in, so you can keep your lifestyle. You can keep spending your money. If the value of your portfolio drops by 5% or 10% or 20%, it doesn't matter, because your income's going to keep coming in. A lot of you have heard me use the rental analogy. Okay? And I use it a lot because it's very illustrative of how our clients' portfolios work. Very illustrative. Imagine you took your portfolio. I don't know, let's say it's $500,000. Imagine you took your $500,000 and you bought a rental home with it. Okay? And you were collecting $25,000 a year of rent. What is that? A little over $2,000 a month, right? So you're collecting $25,000 a year of rent. Well, what's more important at the end of each month? Is it more important that the value of your home stays the same? Or is it more important that the rent's on time? Of course, the rent. Because the rent's what supports your lifestyle. The rent is what you get to spend, right? And let me ask you, along the way of owning that home, home value is going to fluctuate, right? Certainly is. But let me ask you, as long as you're living off the rent and the rent's on time, how much does the fluctuation affect you? If the home value goes up by 10%, does that affect your lifestyle? No. If the home value goes down by 10% or 20%, does that affect your lifestyle? No, because you're living on the income. And that's just important to understand. Right now, in these extraordinary times, these volatile times, portfolios are fluctuating. They're fluctuating down. They fluctuated down more than I've seen in probably 12 years because what's happening now is things that haven't happened for 12 years. So very normal for this to happen. But the reality is that the worst case scenario, the worst portfolio that I've seen so far is down 7%. That's the worst that I've seen so far. So market down 20%, client's portfolio down 7%, much narrower volatility, as I've told you guys. And that's exactly the way that it works. Now, we talk about the fact that your portfolio is going to fluctuate. And some people, when they hear me say fluctuate, they think fluctuation means straight up. No, it doesn't mean straight up, right? It means up and down. And even if you know that it means up and down, there's a significant difference between us having a conversation in my office where we talk about the fact that your portfolio is going to fluctuate and you're sitting on the other side of my conference room table going, yeah, no problem. We know it's going to fluctuate. And then all of a sudden to have it go down 3% or 5% or 6%, especially if you're a new client, it's easy to think like, oh my gosh, fluctuation. I didn't realize it could fluctuate. I mean, yes, Anthony said that, but this is what it means down, and it's easy to get nervous. Everyone's kind of nervous right now. And the whole world's kind of nervous with this whole virus thing going on and everything else. But the bottom line is I've been a lifeguard for 21 years. We've been through this. I lived through 2001. I lived through 2008. Imagine you were going whitewater rafting, right? And I'm the guide. Okay, and I'm sitting in the back of the boat, guiding, turning everything, and we get in the boat, and the waters are nice and calm. And I tell you that there's, level 3s and 4s and 5 rapids coming up. And we get to a level 3, and that was a pretty easy situation, right? That might be one of the, 10 or 12% drops we've had over the last 4 or 5 years. We've had 5 or 6 of them, but that's a, kind of a level 3 rapid. And okay, we hung that in. But now we're coming up to a level 5 rapid. Okay, now we get to the point where you need to trust me. I've been over these rapids 1,000 times. You've never been over these rapids. And, all you need to do is hang on, put your feet under the raft. If you've ever been whitewater rafting, that's how you're going to lock yourself in. Hold on the handles and don't get out of the boat. The worst thing you can do is get out of the boat in the middle of the rapids. That's the worst thing you can do. So, bottom line, your portfolios are protected. Your portfolios are going to fluctuate. We've said that from day one. And you know that. It's just one thing to hear it. It's another thing to actually see it in reality. I had a conversation with someone yesterday that basically said that, portfolio was down about 6%. He goes, if I keep losing 6% every month, then at the end of, 6 months or, a year, I'm going to be out of money. But you and I know it doesn't work like that, right? You don't keep going down 6%, so on. What goes down must come up. Meanwhile, if you're living on your income, you're fine. We have a plan. We've been prepared for this for a long time. That's why we have you invested the way we do. Water's going to be a little rough? Yes. Bad news, they might be a little rougher as we go. Who knows where the portfolios are going to go? If the market goes down 40%, 50%, you can bet your portfolios are going to go down more than that. Hang on. That's what you got to do. Hang on and let your income keep coming in. And the good news, the great news for you is that the farther down it goes, if you're not taking the income from your portfolio, we're going to get some great deals later, and you're going to come out smelling like a rose. 6 months from now, a year from now, 5 years from now, it doesn't matter. You have the ability we have the ability to take this and just make it very good, very profitable for you. So hang on the raft, and we'll go ahead and guide you. And if you have any questions about that, if you're nervous, you want to talk to me, call me. Let me know. You're a client of mine. You're my number one priority at this point, is making sure that my clients get their questions answered. I've had people tell me, look, I know you're busy, so I didn't want to call you. No, call me, please. Call me. Leave me a voicemail. We'll do what we can, even if it's after hours, to get back to you, and we'll have a quick conversation. So I wanted to spend some time talking about that. I wanted to talk about whether it's time to buy. I wanted to talk about the volatility that you're seeing in your portfolio, more volatility than I've seen in a long time. The third thing I want to talk about is a little bit about annuities. And I don't want to give you a broad overview about annuities. I do want to remind you, though, of one feature that every one of your annuities has. And some of you we've had this conversation with. Some of you, your annuity has this feature, and you may never even know that this feature is there. But it's a feature that becomes very, very valuable at this time, and that's what's called an annual reset provision. So if you have an annuity, pay attention. If you don't have an annuity in your portfolio, you can turn the video off now, or you can watch it, because a lot of people are starting to realize that in annuity, especially people that have had annuities for years, it's during the rapids like this, during these kind of rapids, that people are starting to realize that an annuity is their life vest, because they're very, very extremely safe. So, and yet they have one feature I want to talk about, the annual reset provision. But before we do that, let me remind you of how your annuity works. You have what's called most likely an indexed annuity. And index annuity allows you to participate in the upside of the market while protecting your principal on the downside. So when the market goes down, then you don't earn any interest, but your principal is safe. And the annuity does its job in a time like this where the market goes down 20% and you haven't lost a dime. So that's phenomenal. But you also don't earn any interest in a down year. But when the market does go up, and the years that it does go up, you're going to earn some interest. And the reason that the insurance company can protect you from downside loss but pay you interest when the market goes up is because when the market does go up, they don't give you the full gain. So you share in the gains, but not the losses, right? You share in the gains, but not the losses. And there's lots of different ways that annuity companies share in the gains. There's lots of different formulas out there. Every company is a little bit different. But the bottom line is when the market goes up, you make something. You make some interest, some of the gains. When the market goes down, you don't lose anything. So it's good to have an idea as far as that general concept, which if you have an annuity, we've had this conversation, and that should be just a good refresher. But there's a feature in there that with some of you I've talked about, with some of you I haven't talked about. It's a feature that's a good feature, and that feature is called an annual reset provision. And what that does is it basically takes the stock market at wherever it's at on the time that you buy the annuity, and then it uses that value to determine in the following year, the following 12 months from the date of your annuity, to determine whether or not you made interest or not. If your stock market value is higher, you make some interest. If your stock market value is lower, then you're not going to make any interest. So it's all dependent on your contract anniversary. It's not calendar year, it's contract anniversary. So if in fact your contract anniversary is in probably from the latter half of February and on, then there's a good possibility that all the volatility in the market and this 20% decline we've had in the last month, there's a good chance your annuity is not going to earn any interest at all. It's protecting your principal, doing what it's supposed to, probably not going to earn any interest. So that's a good possibility. But what happens though is as the market comes down and you don't earn any interest, then wherever your anniversary date is, that becomes the point at which the annuity company is going to reset the market to wherever that level is. So let's say that the S&P 500 was at 3,000, and let's say that it came down to 2,700. Well, it lost 10% in our example. You didn't lose any money. You didn't earn any interest. But now what's going to happen is the annuity company is going to reset the starting value to 2,700. So now the following year, if the market goes back up, now you're going to make interest. And that's a phenomenal feature. You don't get that feature in the stock market. Because if you buy a stock at 3,000 and it drops down to 2,700, and then it goes back up to 3,000. The bottom line is you've broken even over that time. Because in order to make money on a stock, you always have to be above where you bought it at, right? So if you buy a stock at $100, then you're only going to make money if that stock is above $100. So, but that's not the case with the annuity. So every one of your annuities has this annual reset provision in it. So if in fact your annuity at this point is having its anniversary, then yeah, you're probably not going to make any interest. I think that we could probably assume that you won't make any interest. And then of course, in the next 6 months, who knows what happens, whether you make interest or not. But the reset provision is there. The reset provision happens automatically. You don't have to do anything. Your principal is protected. And then when the market comes back, you'll make some interest on that. And we know with the market, what goes down must come up. It's not going to stay down forever. What we don't know is how long is that going to take. Is that going to be another, 6-month short-term situation? So in 6 months, we're looking back and the coronavirus disappeared and it was really not as big deal as everyone thought. Is that what's going to happen? Or is this going to be a longer-term situation where it might be 6 or 8 or 10 years where we're having to ride out the major storm? I don't know. No one knows. Either way, your money is protected based on what we just talked about now. So I wanted to get that information across to you. Certainly hope that helps. Again, if you haven't clicked on my YouTube channel yet, go follow us on YouTube. And if you're Facebook or if you're on LinkedIn, all those, we use all those there. If you go to our website, Providence Financial Inc., on the homepage in the upper right corner are all of the links to the various social media sites that we use. Go click on YouTube especially. Follow me on YouTube. That way, when we put out another video, you get it right away. You don't have to wait for us to email it. So I hope this helps. Please contact me if you have any questions, especially if you're a client and you just want to know whether you should get some money in the stock market or you just want to have a quick conversation about your situation. So thank you for watching. Hope it's helped. Again, thank you for your trust. Thank you for your business. God bless.